If you are a long-term investor who believes in saving taxes, this video is definitely for you to save taxes in a legitimate way. Do watch it out. Hello everyone. So this video is if you are a long-term investor and wants to save some taxes. A disclaimer before we start the video is I'm not a tax advisor or a tax consultant. So do consult your CA or your tax advisor before going ahead and taking actions on your stocks. Now let's understand what happens if you're a long-term investor who wants to just buy stocks and hold on and might be sell after 4-5 years or might be even 10 years. Why this video will be helpful. If you listen to till the end, you will understand how you can save taxes. We all know that in India, the long-term capital gain tax is 12.5% and short-term is 20%. Now, what do we mean by long-term and short-term? So if you buy shares today and you hold it more than 12 months, or shares or mutual funds, then your taxation will fall under long-term taxes and you will be levied 12.5% tax. But if you buy and sell your shares or mutual funds within the first 12 months from your date of purchase, then you will be considered as a short-term investor and that particular investment will be taxed at 20%. FNO investments or FNO trading is not considered a part of this. So that falls under the business income, which we will cover in some other time. Now let's consider if you are a long-term investor, that means who holds your shares for at least 12 months and sells it later on. How does this scenario work? Say for example, if you bought some shares worth 10 lakhs and to avoid taxes and also might be you because you believe that long-term investments mein paise bante hai, so you hold on to your shares for 3 to 4 years or 5 years and might be once that value becomes 15 lakhs, you sell those and you are levied tax on that 5 lakhs. Now 5 lakhs since you hold it for 12 months and more, so you will be levied you will be falling under 12.5% category and you will be levied 12.5% as LTCG, which is long-term capital gains. Now how can you avoid this? So many people are aware of that 12.5% is the long-term capital gain, long-term capital tax. But what many people aren't aware is that every year 1.25 lakhs, which is annually, it's the exemption. That means you are exempted from 1.25 lakh rupees tax annually. So if you book your gains at the end of that year, in that particular year, after 12 months, and buy the same shares again on the next day, your gains of till 1.25 lakhs will be exempted as well as your portfolio will remain the same. Let's take an example. If you're holding mutual funds or say some blue chip shares like Reliance or SBI. Now what happens is that you made a gain in those particular mutual funds. You hold on to them till 12 months plus. And now you are gaining around at the end of first year or 1 year and 2-3 months, you are gaining around say 1.5 lakhs. Now, ideally, since you are a long-term investor, you would like to keep it for 4-5 years. But what we would suggest is if you can book your gains and lock that 1.25 lakh gains and buy the same shares on the next day after you've sold or buy the mutual funds on the next day after you've redeemed. So what happens is that your capital gains of 1.25 lakhs is locked and those gains in that particular year will not be taxed as well. So now if you combine this 1.25 lakhs for 4 to 5 years, you will easily save around 5 lakhs worth of capital gains. And on that 5 lakhs worth of capital gains, which the amount could be, of course, more than 50-60,000 rupees, which you will save in these 4 to 5 years. Now, combine that with your all family accounts. That means your spouse or your parents or your children, if they are above 18, and you will genuinely save around 20 lakhs worth of capital gains in these 4-5 years. That means annually you can easily save around 5 lakhs worth of capital gains. So amount wise, the tax which you can save is easily about 50,000 if you have 4 family members ke accounts. So isn't this mind blowing? I mean, bete just looking at this video, if it's an eye opener to you, give a thumbs up to us and do like our content if you understood how to gain 50,000 or more annually in your family accounts. Suppose if you're not a long-term investor, then what? Like for example, if you're a trader who keeps buying and selling shares and doesn't hold anything for long-term investments, well, you're doing a little bit of injustice to yourself by not holding for more than 12 months. Let me tell you, you can keep trading, but if some of your portfolio or some shares in your portfolio or mutual funds, if you do keep for long term and there is an exemption limit of 1.25 lakhs, which I think every member or every person should utilize it. It's criminal if you don't utilize this limit given by the government of India. If you don't utilize your 1.25 lakhs, you are doing a disservice to yourself. So net, what I'm trying to say is, if you are a trader, hold on shares for a little longer, till more than 12 months, so that you can get a capital gains benefit. Your prices might also go up, and in the end you will also be able to save taxes on it. Secondly, if you are a long-term investor, then anyways you had that benefit of booking profits at regular intervals and buying it on the next day, so that at least you don't get the big tax burden when you redeem your mutual funds or when you sell your shares. So every year, do utilize this limit of 1.25 lakhs on your shares, which the government of India is giving you the benefit. Do utilize this slab wisely. If you've liked our content, do share, like, and subscribe to our channel below, and book an appointment with us if you want more details on this through our website. Thank you.